Coming to you from the heart of Texas, this is Accounting Matters, the go-to podcast for accounting and finance professionals from your friends at Embark. Thanks for joining us, y'all. I'm Nicole Harger, Embark's National Quality Managing Director. And as always, I'm joined by my co-host, Adam Olson, Embark's Accounting Advisory Practice Leader. It's great to be back in the studio. It seems like we were just here yesterday.
I know.
Maybe it's because we were. I don't know.
Yeah, all the days run together.
Yeah. So today we're going to try to break down one of the new accounting standards from the FASB into easily digestible segments.
Oh, yeah? Is that a tease?
That is a tease. So let's dive in.
Okay.
Back in November of 2023, the FASB issued ASU 2023-07, improvements to reportable segment disclosures. So let's first talk about why this accounting standard update was issued, maybe talking through kind of like a timeline of events.
Yeah, so I think, at its core here with this standard, the FASB, continues to seek feedback from key users of financial statements and financial reporting, so largely investors. And there's been kind of an overarching theme, and we've seen this with a number of other kind of new accounting standards over the past several years, where the FASB is really trying to create more transparency in a lot of the information that's being disclosed. And that's because it's really driven by investor demand. And so disclosures for segment reporting was really kind of no exception to that kind of wave of wanting more information. So just to set some historical context here. So back in 2012 is actually when the original kind of segment reporting standard came out. So what's known today as ASC 280, but back then was basically FAS 131. So kind of the old nomenclature for how we talked about accounting standards. But when that first standard came out, what the FASB tends to do is a kind of a post-implementation reviews where they are seeking feedback, like how well is this standard performing? Are there any, what's the general feedback they're kind of getting from people now that they've had a chance to kind of see this in action? And so as part of that original kind of post-implementation review process, over a third of investors responded to surveys that went out that said they were more or less dissatisfied with kind of the way that the information was being reported under the standard for segments, and really looking to get additional disclosure. So the FASB kind of taking that feedback, then if you kind of fast forwarding a little bit, so in 2016, they agreed to kind of do an agenda consultation regarding kind of improvements to financial reporting, particularly segment reporting. And there was strong preference that, yes, that is an area that investors would like to see some new standard setting being done. And so the original project for kind of where we got to today with this new standard kicked off in 2017 and really was, designed to figure out, hey, let's create guidance that can address some of these concerns. And so as part of that exploration in that project, one of the key observations that was made by investors was that there's very limited disclosures in the current guidance around segment expenses. And so there was a lot of support that they would like to see additional guidance that really enhances the expense disclosures for segments. And so that's really kind of what jump started kind of moving forward with creating the standard that we have today around enhancing some of those expense disclosures, amongst other things too.
So I guess it's safe to say this one has been in the works for quite a while, right?
It has. It wasn't something they just whipped together quickly, right? So I think very methodical process here, and obviously has led to significant changes as well in the space.
Yep. Okay. So before we dive into the specifics and the details, I know the standard header, right, specifically includes the word disclosures. So tell listeners, are the changes for the standard only specific to disclosure requirements?
It is, yeah. So the amendments in this ASU essentially aim to enhance just disclosures of additional segment information, both annually and for interim periods for publicly listed companies, because that's who applies generally the ASC 280 guidance. So just as a refresher, like within current guidance in ASC 280, public entities are required to disclose specific information about their reportable segments. So this includes, reporting a measure of segment profit or loss that's used by the chief operating decision maker, or CODM, for assessing segment performance and resource allocation decisions. And then additionally, that same ASC requires disclosures of other specified segment items like depreciation, amortization, depletion expenses under certain conditions. So the amendments in this ASU, they don't actually change any of the prior guidance that was there, so that carries forward. It also doesn't change, guidance around, for one, how a company even determines what are its reportable segments, or how it thinks about who is its chief operating decision maker, or any quantitative thresholds that are applied to determine reportable segments. All of that existing guidance is unchanged. It's really just layering on additional requirements around new disclosures.
Yep. Okay. So I know as part of this update, there was really kind of 6 main provisions, if you will, I guess.
Maybe.
Segments. Yeah. Of additional disclosure requirements.
Okay.
First being significant segment expenses, other segment items, interim disclosure requirements, multiple measures of a segment's profit or loss, CODM related disclosures, entities with a single reportable segment, and then also recasting of prior period segment information to conform with current period segment information. So I think it's time we kind of dive into the details of the enhanced disclosure requirements companies must comply with as part of this new standard. So let's start with significant segment expenses.
Okay. I guess the update defines essentially significant segment expenses as those that are regularly provided to the chief operating decision maker, or CODM, and are included within each reported measure of segment profit or loss following what they call the significant expense principle, which I know sounds very abstract, but basically public entities are going to be required to disclose now significant expense categories and amounts for each reportable segment. If a public entity doesn't separately disclose any kind of significant expense categories after applying that principle, so nothing falls out for whatever rhyme or reason, then it really still has to disclose at least the nature of the expense information that is used by the CODM to manage their segment operations. And then I think one thing that's important to highlight here around this ASU is, as you're thinking through significant expense principles and thinking about regular information, it's actually what's regularly provided to the CODM, and it's not necessarily whether they use that or not.
Yeah.
So long as it's provided, it kind of is in consideration.
Yep.
So that shouldn't be confused with regularly reviewed by the CODM. It's regularly provided.
Okay. So how does this disclosure requirement differ from what is currently required?
Yeah, so right now there's very limited disclosures around expenses, but there are some explicit expense requirements that have to be disclosed under current guidance. So you'll see things around interest expense, depreciation. Those would have to be disclosed if they are included kind of in the measure of segment profit or loss that is regularly provided to the chief operating decision maker. So for instance here, while selling expenses may have been a part of an entity's profit or loss, prior guidance wouldn't necessarily require selling expenses separately to have to be disclosed because they aren't explicitly called out under that current guidance. Whereas today, under this new ASU, if selling expenses are deemed significant going through this significant expense principle, then they would, and that information was regularly provided to the CODM, then the company would have to disclose that separate expense for that segment.
Okay, so how does one determine what actually qualifies as significant and regularly provided to the CODM?
So it's going to require judgment, right? So it's not explicit, which I think is important because if you think about just the whole concept of segment reporting, it's all really kind of derived around this management approach and management viewpoint. So obviously every company is going to think about things a little bit differently than others. And so you really want insider views into how really kind of management is thinking about the business. And so that would also come as it relates to making determinations around significant expenses. So there's, a number of qualitative and quantitative factors that could be considered when thinking about what segment expense categories would qualify as significant. So no specific definition there, at least on the significant side. When it comes to regularly provided, it also doesn't necessarily define what that timeline looks like what is considered regularly provided to that CODM. I think in practice, I've heard a lot of people floating around the ideas of, we interpret that to mean like it's information that is at least provided quarterly. So if you think about kind of like quarterly board reports or management reports that are going to that CODM, that would probably qualify. But then even as recently as this past December, I know you and I, we were at the kind of the AICPA SEMA conference where the SEC also spoke kind of on this new standard from the FASB, and in discussions with the SEC staff, they even kind of highlighted that frequency less than quarterly from their vantage point could be considered regularly provided. So maybe even a lower threshold than that quarterly cadence. So I do think a judgment as well needs to be considered there when companies are thinking about like, okay, it might be significant, but is it also regularly provided, that it may be something that is, you know, is given on a more regular cadence than that. And so I think when companies are going to start navigating this kind of significant expense principle and thinking about information that's regularly provided, like a good starting points is obviously those CODM packages or segment information that can, in today's world, it comes in a lot of different formats. You know, it's not just this bound book that comes like it was in the old days. I think there's a lot of regular dashboard type reporting that's probably used by CODMs and more like interactive and real-time reporting. So just thinking about all the avenues in which information is provided to that CODM, that's probably the starting point to evaluate for significant expenses. But companies also need to think about significant expenses in the context of things that could be easily computable from other expenses as well. That's a term that's also kind of outlined in the standard. So there's a number of different ways companies need to kind of be thinking about that. And then even from period to period, like, right, there could be changes in this. So there's going to probably be, you know, the standard gets into, and I'm sure we'll talk about it today, is the need to almost like recast a lot of this disclosure information. And it's because maybe what is significant from one period to the next doesn't always align. And you got to be thinking about like updating that to make sure that you're being relevant with what you disclose.
Yep. Okay. So you used the term easily computable. Going back to the standard, there are no definitions or specifics on how to determine what's significant or regularly provided. Let's focus on that term, easily computable. Does the standard actually outline any details there?
Yeah, it's really trying to get at, you can have significant expenses that maybe aren't expressed in a traditional dollar format that could be derived from other information that's regularly provided to the CODM. So for example, you could have a certain ratio or an expense that's a percentage of another benchmark. So like certain things might be certain percentages of revenue that could then kind of infer that there is a significant expense that's easily computable based on that assumption.
Okay. So what are some examples of easily computable information that would be required to be disclosed?
I can give you a few here. So one of the most common ones that comes to mind is going to probably be around cost of sales. So like a lot of times a CODM is obviously given the segment revenue, already required disclosure, and then there's always segment gross margin. So if you have two of those numbers, you can easily compute then what is the implied kind of cost of sales from those amounts. So easily computable. So in that case, if cost of sales is significant, which is hard to argue it's not, you would have to disclose that as a significant segment expense. Similarly, there was also an example in the basis for conclusions within the standard itself, and it related to interest revenue and net interest margin being regularly provided as well to the CODM for a financial segment. And so with interest expense considered easily computable from this information as well, it would also be required to be disclosed if significant. And then similarly, again, kind of the last example here, maybe from more of a traditional consumer type products or commercial type entity. So like bad debt expense, credit loss expense, if you think about CECL, or marketing expense, a lot of times those are expressed as percentages of revenue. And so just because it's a percentage of revenue, you are able to easily compute or derive what that expense would be. And if it was significant, then you would have to also, and it's regularly provided to that CODM, that could also qualify as a category of expense that you would have to separately disclose.
Yep. Okay. I think all that's really helpful. For the first provision, let's jump right into the second one, which is what we're calling other segment items.
Yes.
Let's talk about that.
So the ASU also mandates public entities to disclose for each reportable segment an amount for other segment items. and what is meant by other segment items, it's really just the difference between the reported segment revenues less your significant segment expenses that you identified through kind of that significant expense principle, less the reported segment profit or loss. So it's almost trying to like just reconcile that like other kind of general category of stuff in order to fully kind of like have the full picture of everything that falls into that revenue and kind of profit or loss measurement as well. So it's filling in that space there. What you do have to do here is it's really just more of a qualitative disclosure that describes what is in that group of other segment expenses. Like, so just talk about the composition, so the nature and type of the expenses in that group. You don't necessarily have to quantify what those other expenses make up, but you do at least have to describe kind of what's the nature of those expenses.
Okay. So what are some examples of other segment items?
Yeah, so there can be a lot of things that are in there. So obviously it's all the total amounts of expenses that are included in the reported measure of profit or loss, but are not regularly provided to the CODM. So those types of expenses, it could be segment expenses that are not considered significant as well, that you didn't deem that, so you obviously didn't pull them out. A lot of times it could be like gains and losses or other amounts that also are factored into the segment's profit or loss measurements. So there's a number of, kind of different things that could qualify as falling into that other group, but that's broadly how you would think about it. But then you probably would want to drill in and explain a little bit more, at least some of the larger categories or nature or types of expenses that fall into that other bucket.
Yep. Okay. So moving on to the third provision of the standard update interim disclosures. What are companies now required to disclose on an interim basis?
Yeah, so they've really enhanced the disclosure requirements for segment reporting on an interim basis. So now public entities are required to disclose significant segment expenses and other segment items, as well as all existing segment information about profit or loss and assets on both an annual and now an interim basis. So these include having to disclose reported amounts, measures that include things like obviously the segment profit or loss, total assets, revenues, interest revenue and expense, depreciation, depletion, and amortization, unusual items, equity income of investees, significant non-cash items, equity method investments, et cetera. So there's the whole kind of gamut of stuff that is traditionally done on an annual basis is now going to be required for interim disclosures. And this is in addition to obviously just the new guidance we have now around just significant segment expenses that are now being required on an annual basis. Those also apply on an interim basis as well. And I do think some people might be a little hesitant around like, well, crap, like it seems like a lot more work now that we have to do on an interim basis. And obviously the board factored that in probably as part of the project and outreach and how they kind of came to their ultimate decisions when they issued this new standard. But their viewpoint here is like, this is really giving more timely decision useful information to users of the financial statements, so investors, lenders, et cetera. And it's not really placing that much more burden on preparers, because a lot of the information that is being used to prepare these disclosures is already things that exist in those public business entities, own financial systems and records. So it's just a matter of having to compile and present that.
Okay. The fourth provision of the standard provides some clarification around multiple measures of a segment's profit or loss. What can you tell the listeners here?
Yeah, so this is kind of interesting, I guess. So under the new standard, companies are allowed to disclose more than one measure of segment profit or loss, as long as at least one of the measures aligns with a GAAP measurement principle. So what's kind of known as the required measure. So for example, if the CODM utilizes multiple measures of a segment's profit or loss for performance assessment and how they're going to allocate resources, et cetera, that entity has the ability to report one or more of those additional measures. So long as, like I said, one at least is derived from a kind of a GAAP measure. So for example, if a CODM uses gross profit and also EBITDA, which is commonly that we see that measure used by CODMs as a measure of segment profit or loss, that entity could only disclose gross profit, since it does represent the measure that's most consistent with amounts included in the consolidated financial statement, so kind of a GAAP measure. Or it could also disclose gross profit and EBITDA. It couldn't just do EBITDA on its own. It has to at least have the one that's closest to a GAAP measure.
Okay.
But they do have the ability to have more than one kind of profit or loss measurement under the new standard. So, it's something that historically we haven't seen. And a lot of times that would tend to come up as if a CODM is using a measure, a lot of times that's disclosed, and it's usually kind of falls into this kind of non-GAAP measurement realm. But now this standard is almost kind of calling out, hey, you do have the ability to put forth more than one measure if that's used.
Yep. Okay. So I know there are also additional disclosures specific to information about the CODM. What can you tell listeners about this fifth provision in the standard update?
Yeah, so now there's a requirement to include specific information about the CODM. So you don't have to
who they are.
More or less. It's just you don't specific, like if it's an individual, it's not like you have to disclose their name themselves, but you do have to disclose the title and position of that individual. Also, in some situations, companies, the CODM is more defined as kind of a group or a committee. So if that's the case, you just have to define and name who is the group, who is the committee that is the CODM. Companies are also required to disclose how the CODM uses the reported measures of segment profit or loss that we just talked about in assessing segment performance and deciding how they're going to allocate resources. So again, just a little bit more information for how that person or this group or committee is using all this information that then is leading to what ultimately is going to be disclosed in these new standards.
Okay. So how does all of this apply to a company that only has one single reportable segment? What does the final provision in the standard state on this?
Yeah, so I guess fortunately or unfortunately, it depends how you look at it. If you are a company that only has one reportable segment, you are not excluded from the new disclosure requirements. So instead, they must provide all disclosures required by the ASU, including significant segment expenses and other segment items. And this is also along with all the old mandated existing segment guidance. So previously, if you only had one kind of reportable segment, you kind of followed the entity-wide disclosure requirements only. You didn't have to deal with all the other kind of noise.
Okay.
And that's now going away.
So in addition to the main provisions in the standard update, the FASB also amended ASC 280 to replace the word restate with recast as it relates to conforming prior period segment information to current period segment information. What do listeners need to know here?
Yeah, so one, it was a terminology update. So the prior guidance, technically, since this is now final, did used to have the word restate and kind of explaining how to handle those situations where maybe certain information changed. And they did change that word to recast. And I think that was just to clarify any potential implication or confusion with that. Maybe someone might perceive that there was an error in the previously reported segment information. So that has now been rebranded, I guess, as part of this new standard. But kind of what I was alluding to earlier, if an entity changes the segment information regularly provided to its CODM in a way that potentially does alter how they identify what are significant expense categories, or if internal reports or information that is provided changes in the current period, like the company would be required to recast all periods, including their interim periods. Unless doing so, they always have this impractical, kind of carve out little phrase in there. But they would be required more or less to recast all previously kind of reported information so that it does align.
Okay, and so I think we'll get into the recasting as part of the adoption and transition here in a minute.
Yeah, so obviously there'd be some recasting that needs to be done for the transition, but then just even going forward, if there is, that's something you got to think about as you should be continually evaluating, especially that significant expense category line item could change from period to period. And so if that does change from one reporting period from the prior, then you need to think about recasting, prior information that's presented so it is comparable. Yep.
Okay. So we'll go into the specifics there here in 1 second. But now that we've kind of covered the details and the specifics of the standard update, I think the next obvious question is, who is impacted by this update? And I don't know, maybe we should have talked about that first, but here we are.
I've probably been alluding to it because we've been saying, obviously, like public business entities, right? Anyone that's subject to ASC 280 previously is obviously going to be impacted by this. So, right. So like public companies are the ones that are mandated. I would say like there are some private companies that do elect to apply full ASC 280 guidance in its totality. And so, just thinking about like if you are that entity as well, then equally you would have to adopt this to fully be compliant. With that ASC 280. And like I said, like it's something that private companies still have to think about, because especially if you are looking to enter the public capital markets, you're preparing it for an IPO or you're getting acquired, you're likely going to have to include that information in your registration statement. And so it's just, it's something that oftentimes comes up for private companies as they're kind of etching towards that. So just maybe something else to keep on a radar if you are a private company that is thinking about an exit strategy that involves an IPO in the near term.
Okay. I think that's good information. So the standard is effective for fiscal years beginning after December 15th, 2023, and then interim periods within fiscal years starting after December 15th, 2024.
Correct.
Companies,
so right now, basically, right? Or at least for this annual period.
Yep. And so companies can elect to early adopt. How do companies apply the transition guidance? Yeah.
So, and I will just say on the early adoption, that was actually another point that was raised by the SEC staff as well. So they were actually very encouraging that companies should early adopt this in like their interim periods as well in 2024 and really just apply it throughout the entire year and not wait on that. But to your point, like there is an additional year before technically the transition guidance would require it to be applied in interim periods. But upon transition, just to kind of back to your original question here, a public entity is required to apply this, retrospectively to all prior periods presented in their financial statements. So this means that significant expense categories and amounts disclosed in prior periods should be adjusted based on the significant expense categories that are identified and disclosed in the period of adoption. So you just need to align. You go through that exercise, a significant expense principle, identify what all those are, and then you need to align that with anything that was previously reported.
So given the standard must be applied retrospectively, companies would need to consider the impact of adoption on historical financial statements that were included in previous reports filed with the SEC. Will companies need to reissue previously issued financial statements as a result of adopting this new standard?
Yeah, I think it maybe, right? So I think it's something companies are going to have to think through, reassess the materiality of, that retrospective adoption and impact any previously issued, financial statements. So looking through their Form 10Ks and 10Qs, especially in connection with any new or amended registration statements. And I think that's going to require conversations with auditors and probably their legal counsel and things like that to determine whether any of those previously issued forms may be required to be recast. So, to have to file kind of a Form 8K as part of that. So that's something that companies definitely need to be thinking about. They also need to probably think about the impact on the adoption of segment level disclosures kind of elsewhere within some of their filings. So if you think about business owner overview, kind of MD&A, typically a lot of discussion around segments and things there. Just other areas where this information tends to bleed out in some of those filings, thinking about whether it's material enough there that we need to also recast other parts of that filing, kind of even outside just the financial statements themselves. And then obviously just kind of similar with any new kind of accounting guidance or principle that you adopt, you obviously have to have sufficient disclosure around the adoption of a new accounting principle, explaining kind of the impact so the users can understand, okay, this is now being applied to in this filing as well, and here's kind of the implications of that new accounting guidance. And then I guess we probably don't talk about it as often on this podcast, but just even thinking through just like operationally as well. If you're introducing new guidance and new evaluation here, especially around significant expense categories, I mean, likely could be changes to internal controls. might be materially impacted around existing processes or controls. So just kind of thinking about that, and any significant changes there may also have to be disclosed as well within item 4 of Form 10Q or item 9A of the Form 10K as well around those changes.
Okay. So I guess as we wrap up today's discussion, are there any last minute reporting considerations companies should be thinking about?
Yeah, I guess maybe, and I think kind of very quickly skirted up by this, but historically, like I was saying, if we go back to the multiple measures of segment profit or loss, so historically ASC 280 limited registrants to disclosing only one measure of segment profit or loss in the financial statements, and then any additional measures outside of that were always relegated as being kind of non-GAAP disclosures outside the financial statements. And then if it is a non-GAAP disclosure, then it's obviously opens it up to a whole host of SEC regulations around non-GAAP disclosures. But since this ASU does allow for multiple, measures of segment profit or loss, it does raise questions around some of that non-GAAP measure considerations. And I do think that there isn't true consensus on how companies need to be thinking about how do you consider if you're using multiple measures, because it's in an ASU, which is accounting guidance, but it doesn't explicitly call out that this is the type of non-GAAP measure that you have to use, whether or not using two measures still, includes you in the guidance for non-GAAP measures where you would be subject to that under existing SEC rules, or how does that play? And I think what I've heard and what I think a lot of people are potentially waiting for is maybe more interpretive guidance from the SEC around how to think through that.
Yeah.
My guess would be is the SEC is still going to enforce their non-GAAP kind of measure rules around using multiple measures, and not kind of take the point of view that, the second measure, which may be non-GAAP in nature that's included in that disclosure, is prescribed by the FASB, but really it still qualifies as non-GAAP and would be subject to that regulation. So I do think there are some nuances there, and it obviously only impacts you if you're using multiple measures, but just something to watch, I think, or think through and talk to at least your auditors, your SEC counsel, and others for kind of perspective on how they think about that and how they might view that.
Yep. All right. Well, I think that was a good conversation. The standard was only released in November, I think.
It's only been a couple months, right? And it's effective basically the end of this year for annual reporting at least. So there's, and it's been a long way coming, right? We talked about that at the beginning. It's been multiple years in the works. So I think people, at least if you follow kind of standard setting activities closely, maybe it's not something that just caught you off guard, but there probably could be some companies that aren't as in tune to some of this stuff that are like, oh yeah, this is something we're going to have to deal with now.
Yep. So at least it's, I think companies are probably underwater with year-end reporting, but something else that they need to be thinking about very quickly after that. So
yeah, especially if you're thinking about, that early adoption and really wanting to include it in your Q1 reporting, which, for most companies will be, due in May. So not that far off.
Yeah, that's right. All right. Well, thanks for your time today and great conversation as always. To our listeners, thanks for listening to another episode of Accounting Matters. Feel free to reach out to Adam or I on LinkedIn. Have a great day.